Greetings folks and welcome to Q&A for February 25-26. Listen to the market. First of all, I want to thank those of you who've been putting in comments and questions in the YouTube channel. Let's get this ball rolling. And a very big thanks to those who've gone the extra step and have sought me out and have managed to catch up with me. I'm not hard to find. And we've had some great chats via Skype. So keep them coming. Now, whilst I've been chatting, there's been a screen grab on the screen that you've probably been looking at and saying, what is this all about? Well, quite simply, that is what a L.I.V.E student or a L.I.V.E practitioner sees when they're trading. You can see very clean lines, very organized, very orderly. And that to me is an important aspect in terms of trading, especially applying the L.I.V.E concepts and rules, which are disciplined and orderly. You'll see three larger charts up at top there, 1, 2, 3. They're the primary source of interpretation. In other words, they're the charts that you use to come up with your decisions of setups, of direction, of entry and exit, campaign management, profit taking, everything. That comes from a source different to the data from the broker itself. So this is the data platform from the broker, the charting platform, that's the broker platform there. The reason for having the two different sources of data is so that you minimize on the effect of slippage, which happens when orders are bunched. So logically, of course, if you're using the same platform as everybody else with that broker, probabilities will have it that your levels will coincide with a whole bunch of other buy or sell orders. By taking the data from a different source, which again by definition will be different, you get around that issue. Now the guts of the screen here is what I call the SAT sheet, which stands for the Setup Analysis Template. Now that's a specifically designed spreadsheet, which is part journal, part status management, position management, and also a tool to work out your entry levels, your size, and all your ISL levels. So as the market's unfolding, the operator fills in over here what they're seeing in terms of a smaller time frame, whether it's a 5-minute time frame, so every 5 minutes they're putting in some comments, as well as the 60-minute view and the 30-minute view. There's an area there for comments in there, as well as comments in there. On the left, there's what I call the status bar. So that lets the operator know what their current position is. In this example, long, it's period 1 of the campaign. That's the size. You can see their stop loss level in through there. Once the high and the low are filled in, the software takes over automatically and calculates the bet size for the new campaign, as well as the entry level and the ISL level. So that gives you an insight as to what a L.I.V.E operator sees when they're working with the markets. Clean, orderly, and organized. Just the way it should be. Okay, now moving along to the next part. The question was, during the week, what am I talking about in relation to an efficiency factor? Well, it actually comes from an article that I wrote for the Australian Technical Analysts Association back in the early 2000s, and it's an idea that I've worked with for, I guess, the last 20 odd years. The aim is to see how well your set of rules captures a given market movement. So we're looking to see, okay, the market movement here was up, the entry level, for example, here using the L.I.V.E approach was just in through there, and market rallied and you got out on the break of those lows. Comparing that to another trading approach, swing trading for example, or even a moving average approach, again the entry level has been plotted for that approach as well as the exit level. So what we're looking to see is how efficiently one set of rules captures a market movement versus another set of rules. Let's fill in the details. Obviously, the optimal buying point is at the low. The distance between the low and when you do get in is the amount of confirmation you need to believe that this is the beginning of a movement up that you wish to partake of, you want to trade. The ideal exit point, again, naturally will be at the extreme. And whilst in theory it's possible to occasionally buy the low and sell the high, my experience is that generally we do the reverse. We sell the low and buy the high, unless we're very disciplined. Hence the L.I.V.E rule set. Now, in terms of not exiting there, but waiting for the market to reverse, the distance between those two is known as the giveaway factor. How much do I give away of my profits to get out? So the swing traders got long on the break of the swing. The moving average approaches got long, going above the moving average. Swing traders get out on the break of a swing low. Trend following moving average approach gets out on the break of the moving average. The L.I.V.E rule set gets you in earlier and gets you out earlier. And the difference between the two is what you get to keep. The idea of running an efficiency factor all the time is to monitor how well your entry rules are performing and how well your exit rules are performing. Should the performance start to go downhill, yes, you'll see it in your profit and loss, but more importantly, you'll be able to access, you'll be able to see whether it's as a result of your entry or your exit rules. So that answers the question about the efficiency factor. Next question that came along was, do the L.I.V.E setups and concepts apply only to the euro dollar and only on intraday time frame? Well, rest assured that the L.I.V.E setups are universal. Now, what I mean by that, they can be applied on any market, any time frame, anywhere in the world, as long as it's a mass traded market. Weekly chart of crude oil futures, and you can see quite graphically how the little VT buy captures the movement up through there, reverse from long to short. You would have been stopped out before that. Reverse to the short side there, courtesy of an FO sell, capturing that movement there. There's no formal setup for that dead cat bounce through there. However, there is a nice regular retest of that high to capture the next movement down. This little dead cat bounce is captured by an FO2R, which then morphs into a 3S sell. It's a whole brand new language, isn't it? After the fall, the setup that catches the very low point, the low bar, weekly basis, is a gorb. Market then starts to stage a rally, and a IPO catches the next movement down. So there's an example on a weekly chart. How about a daily chart? You got it. Gold futures, another popular trading vehicle. And you can see again how the L.I.V.E setups quite nicely capture the turn or just before a turn. Nice little gorb down the bottom here. Little staircase to hell, staircase to heaven up there. Acronym city. So yep, L.I.V.E setups are universal in their application. I always urge people to get away from the stock standard time frames and analyze and work with charts that are not standard. So hey, start looking at 3-hour charts. Start looking at 55-minute charts. Start looking at 13-minute charts instead of 15. The same setups will appear at turning points, at lows, at highs, at final tops, and 99% of the time there'll be a L.I.V.E setup that enables you to capture the large movements that come along on a regular basis. One of the chaps that I was talking to during the week, actually a trader from Chicago, where I lived for a while back in the 80s, was saying to me how regularly on a 1-minute basis there is opportunities for at least a 1-hour or 2-hour quick trade in the market. And whilst I agreed with the chap, my thoughts were, well, yes, in theory it's possible, but it really depends on a lot of factors. Obviously, the trader themselves and their knowledge and ability, but also things like their internet speed, to a smaller extent their computer speed, their broker, and whilst it looks great to do it really, really quickly, it can be very intensive. So whilst it's good, there's also negative sides to it. Now the final comment I want to make to you is results are directly proportional to the efficiency of your entry rules and your exit rules as you're beginning to gather, your campaign management, that includes adding on, scaling in, scaling out, money management, which I'll spend some more time on next weekend, and more importantly, the U factor. This is often the make or break between these performing well but not giving the results that you're looking for. So keep those questions coming, guys. Thank you very much. Catch you next time. Bye for now.